Hello and welcome to Big Deal. I'm Nisha Poddar. Now, startups are in focus on the show today as Mamaearth listing really lifts the confidence in the startup space for value unlocking and also investor exits. So what are the various options as funding winter really continues, and what's the ground reality on deals for the startups? Let's find out from the experts. Karan Sharma from Avendus Capital, Disha Singh from Zouk and Rahul Chowdhri from Stellaris Venture Partners are here on the show with me. Lady and gentlemen, thank you so much for joining us right here on CNBC TV18. Now, my first question to you, Rahul, of course, many congratulations. You had a great exit, partial exit in your portfolio company, Mamaearth, through an IPO, and this has lifted the confidence. What has been the impact, you think, of this IPO on the overall investor sentiment?
So, first of all, thanks, Nisha, for your wishes. In terms of IPO, I would say this has been, over the last 2 years, there has been no IPO that from a company that was VC funded. So people were eagerly awaiting as to, how this IPO goes. And clearly, if you look at the quality of institutional investors they attracted, it has been a very successful IPO in that sense. And it does give confidence to other late stage or late stage companies on how to build for the public market. Clearly, people want to see size, scale, growth, but investors in India at least would also want to see profitability as a matrix. And in that sense, this IPO is a kind of a culmination of both of those factors.
Okay, so Rahul, definitely it's also a culmination of many factors, as you said. But, one aspect that everybody has been harping on has been the valuations coming in from the startup space, especially in the IPO market. And we did see the value of, Mamaearth after listing take a huge drop, and now it's on path to recovery. Have we got the right mix of valuation metrics for this space, in your view, for any future IPOs coming in from the portfolio companies and from this space? As an investor, and giving a big picture view on this space, what do you think? Especially also pointing out one important aspect, that the retail investors have not been as exuberant in these IPOs as yet. Is that also a worry?
I would not say it's a worry, although I would also say that what this IPO says is that most of the institutional investors want to see profitability. And the valuation that you get is maybe 18 to 24 months forward multiple on your profitability. And that is what I think Mamaearth is getting. In terms of retail investors, again, hard for me to comment. We are not public market investors. But I would say, it's, again, when they start seeing company deliver performance on a consistent basis, hopefully that also starts playing into investors' mind.
All right. Thanks, Rahul, for taking all the tough questions on the behalf of the entire fraternity of venture capitalists and startup IPOs. Let's take that question to Karan. Karan, you have seen a plethora of deals and startups from in different, curves of their life cycle, as well as in different options when it comes to value unlocking, investor entry, as well as exit. How do you see the present situation, and do you think that more IPOs are in the pipeline?
Thanks, Nisha. Nisha, we see that, it's not that it's going to be floodgates open for the IPO market. I would say IPO is a key milestone that a company thinks about. It's not the end outcome. We expect on the tech side, maybe a dozen odd IPOs in the next 12 to 15 months. And a key reason for that is we believe a lot of companies are now getting ready where they can be appreciated well by public market investors, and where they have the governance, the frameworks, and the stage of maturity of the business models that can also be widely recognized by the wider set of public retail investors. Companies are turning profitable. They are demonstrating, corporate level EBITDA profitability, which has always been a key factor for public listings in India. So I would say it's coming of age for the entire industry, and we believe companies are now getting ready where they could explore their public market phases. So there's one aspect that we're seeing in terms of the market where a dozen odd companies, today we see around 30, 35 unicorns already profitable. So I expect at least a dozen of them to tap the public markets in their own respective journeys to solve specific requirements in the next 12 to 15 months. And on the other hand, we have also seen over the last 2 to 3 years, good secondary liquidity, which has been generated in the market to, deliver returns to investors, send money back to LPs. So you've seen around, around $8 to $10 billion worth of secondaries in the last 3 odd years, which always, eases up the pressure on the companies to provide exits through IPOs. So it's a good combination of potential public listing as business models evolve towards profitability, along with secondary exits. M&As continue to be on the sort of a lower trend in recent times.
That's right. So that's a good overview and a very balanced approach that you have given, Karan. Of course, the market has matured, there is understanding, but doesn't mean that the floodgates have opened for the IPOs from this particular space. There will be cherry picking from the investors' point of view, and getting back the retail investors' confidence probably will take a little more time because of the burn that they have seen in the last season where a lot of lessons were learned. But taking it to one founder from Zouk, Disha, thanks for joining us on this discussion. Wanted to get a founder view from this particular space. How do you view the present optionalities for the exits of investors? And is IPO market is one of the key drivers also? Because when investors come in, they're coming with the sole purpose of return matrices at the time of exit. Let's be very clear about that.
Sure. So, Nisha, first of all, thank you for having me. Right. Of course, I think IPO is 100% one of the exit optionality. In fact, our investors, Rahul is one of them, is here as well, right? I think they have been the biggest supporter and helped us dare to think about it. Rahul has closely seen Honasa's journey from early stage to IPO. We also have other investors like Titan Capital and Rishabh Maliwala who have also seen that journey. In fact, another interesting thing that we did on was to convince a lot of exciting large consumer brands, founders like Mamaearth, Sugar, Wow, Beardo, to name a few, on our cap table. And they all are folks who have dreamed big and built massively loved businesses in a very short span of time. In fact, we were Varun's first angel investment. So overall, I think they all are very aspirational for us, and most importantly, all of them collectively want us to build the right kind of business that can run for decades. And of course, IPO, it will be another milestone in that journey.
All right, IPO definitely on the radar of the investor, especially when they are making the investment also as one of the exit options. So Rahul, of course, Zouk is a portfolio company. You want to begin by what you saw in this particular company while investing, and what is your focus on the portfolio companies now that you make new investments in a changed environment currently?
So first of all, Zouk was a very unique brand when we invested, I think more than 2 years back. It was a smaller company at that time. What we really liked was how founders were thinking about the brand and the connect they had found with the consumers. So this is a very unique brand in the sense that the designs or the formats are all Western, but the looks are all Indian. And that's what a young Indian woman is looking for today, be it bags, be it shoes, travel, and so on. And that's what we felt that this is a brand that can grow into multiple categories, and that's why we invested in them. We continue to stay very positive on new age consumer brands, and we have made few other investments there. Beyond brands, as a fund, we are a very broad-based fund. So we have made few investments around generative AI. Recently, we announced a company called Dashtune, which is in the consumer space but uses generative AI at the backend. Quite positive on the EV as a space. We invested in a company called Turno, which is in financing of commercial EV vehicles. Fintech, sustainability, we recently invested in a company called Circla, which is building sustainable packaging solutions for global markets. So quite broad-based, and at least as an investor, our thinking is, what is it in the company or the value proposition that can become a very large outcome in, let's say, 7 to 10 years. That's the horizon we take, and that's how we make and choose our thesis and areas of investing as well.
Right. And when we talk about the investor sentiment, of course, funding winter really continues right now. Karan, where are we in that particular space? Like, is there now a little bit of green shoots visible, or are we continuing to see a funding winter which is going to be prolonged?
Sure. So Nisha, the funding winter was largely, I would say, the two key factors. One is we saw a big funding frenzy where we saw the last, 2 years, FY 22, 23, we saw almost $60 billion being raised by the industry over 2 years. So which meant that a lot of companies were capitalized. I think they managed their dilutions well at rich valuation multiples. So it was a no interest, low interest kind of a era of fundraising, which meant that obviously there had to be a pause from just a demand perspective of companies looking to raise further capital. And then obviously with the kind of a macroeconomic cycles, we saw massive decline in fundraising in the last, I would say this current year, where it is just about, I would say, $8 billion on the tech side as compared to $20 billion in a year before and almost 40 odd billion the year prior to that. So yes, we are seeing that kind of a crunch. At the same time, we are seeing investors, especially private equity, sovereign funds, pension funds, continue to be active. They're looking this as a good opportunity to evaluate companies, take their own sweet time to do their diligences, build the conviction on the business models, and come in. We're seeing that level of activity from these kind of funds. The funds that we're not seeing as active in this phase are really the crossover funds and the hedge funds. I think they have taken a bit of a pause given how the overall market view is. However, I do see some of this trend reversing. We are seeing that momentum getting built in, and a banker's bullish view, I would say. I expect the next 12 months to start reversing the trend, and maybe FY 22 is an outlier, but yeah, we have to see this in 4 to 5 year phases, and I believe the next 5 years look far more promising than the previous five. And India as a market certainly is going to be a big beneficiary of private equity and venture capital as an investment destination.
Right. So two important takeaways from you, Karan, from the deal street and the funding street. First of all, very, very positive view coming in for the next 5 years in this particular space, and likely pick up in funding activity in the next 12 months. That's good view coming in. But hold on to your thoughts, lady and gentlemen, because we'll take a quick break and we'll talk more about the value unlocking proposition, the optionalities and fundraising in the startup space right after this short break on Big Deal. Stay tuned. Welcome back. You're watching Big Deal and we are discussing the value unlocking and investor exit propositions in the startup space. Now, Karan, we were discussing the IPO market, the valuations. I want your view on the valuation metrics because we did take the example of Mamaearth, which is a recent listing from this space, and its valuations something that we can now draw analysis from for the future IPO pipeline from this space, and versus the secondary sale. So which is the theme which is picking up, and how are the valuation matrices working out?
Sure. So Nisha, the good part is that the industry, especially on the tech side, and most of the IPOs that we expect, we will see far more on the consumer side of it. We'll see fewer on the B2B, SaaS side. So on the consumer side, the good part is the conventional industry players there's a lot of listed peers. People are looking at EBITDA multiples forward 1 to 2 years. And the good part about Indian public markets is we look at a certain growth profile, which is 20-25% onwards. We see a healthy ROCE profile, which is return on capital employed. And if you look at a bunch of 30 to 40 such large consumer retail listed peers, you'll see EV by EBITDA multiples right from 25 to 35x zone, and that's how most of the investors are approaching these tech startups. Obviously, they're applying these multiples more on what the stable state EBITDA of these companies could be in the next 12 to 24 months, and then discounting it back. So the good part is the discussion is more about now EBITDA multiples rather than revenue multiples or GMV multiples, which was maybe a scenario 2 to 4 years back, but that is undergone a change. And on to a second question on how one should think about the secondaries and the public market scenarios. I think it's a sequencing aspect, as I would like to see. See, in India, companies would always take a bit longer, in their journey to list, which means how a typical VC or a private equity investor, the investment time period that they would assume for them to see an exit in a company. In India, it could be a couple of years longer than, say, a mature market like the US, which means that if they are, 4 to 5 years into their investment journey in a company, then secondaries are an interesting option for them to sell part or large portions or even full secondary stake to another private equity or a secondary focus fund. So that rollover, ensures that there's not too much of pressure on the cap table when the company looks to list. Yes. And the fresh pair of investors who are there in the next phase of journey for the next 3 to 5 years. So we see secondaries as a good kind of a product for investors to explore and have an interim return option for them, as compared to pegging hopes on a long-term IPO journey. So it's a combination of both that should solve the overall, I would say, liquidity requirements of the investors.
A very important point made by you there, Karan, because as from what I have understood, the private equity industry, which is much more progressed in terms of understanding the public market, the IPO, as well as the growth stage companies, probably can act as a buffer for even the IPO preparedness of the companies. Rahul, what's your view on that, and how is this trend really picking up for the VCs?
Nisha, fortunately in our case, we do have a longer time horizon. So our funds are typically 10 plus 2 years. What this means is we can stay with the startups at least from 7 to 10 years. And if need be, extend that journey as well. So if we think that the company can go IPO in, let's say, 12, 14 years also, we are perfectly open to staying along with that. Giving or getting some secondary exit has a different motivation. It is less to do with, is the company taking too long? It is more to do with providing some liquidity to our own investors. And we actually did that in Mamaearth also in 2020. I think we took a small stake that we sold, but stayed with the company for a larger stake of ours. So yes, if you are a fund which is much shorter time horizon, I think founders should understand when they raise money from those investors that, in 5-7 years, there has to be some exit that needs to be provided. In our case, fortunately, that's not needed.
All right, not in your case, but Disha, coming to you as a founder, What about the IPO preparedness from the founder community? You, I'm sure, have a conversation with several other entrepreneurs of your type, and how are the change in the view that public market takes on the matrices being accepted? How is that approach being seen, and are founders able to really prepare their companies on those matrices?
I think as Karan and Rahul both have said that a lot of things have changed in the ecosystem in the last 2 to 3 years. The matrices that we were looking at 2 3 years back are not something that we were so keenly looking at right now. Of course, growth is important, top line is important, but I think founders are also realizing, and I think the overall ecosystem is also realizing this, that if in 5 to 7 years you want to go IPO as a company, then there are a few more matrices that you need to look on, and the most important one of them would be, of course, capital efficiency and being EBITDA positive, as Karan was saying, because that's what public markets values the most, and that's the change that we are also seeing across it. And I think at Zouk we have always taken pride in being capital efficient for the very long time, and I think that's how we are building our business. Given Nisha, Zouk is our life's work, and I think we want to take Zouk IPO in next, maybe 5 to 6 years. And now we understand from all the IPOs which has happened in the last 2 years that it does take its own time to prepare for the IPO, and the matrix, like the preparedness might happen 2 years back from the date of IPO that you want to go, but the whole matrix focus has to start from the very, very beginning, maybe 5 6 years before when you think.
No, that's right. You have to be prepared for right from the beginning, and there are several aspects to it in terms of cash generation, EBITDA positive, and also the corporate governance standards. Very quickly, Karan, final word. You said that M&A is not something that is ringing in well in this particular space. Any particular view on that? And do you see a theme picking up even in terms of consolidation, VC-led consolidation? Anything that you see on the horizon? Very quickly.
Sure. So, Nisha, we see, a lot more scrutiny on capital deployment of larger companies by their boards as to, where they believe they could be good acquisition targets. I would say market consolidation in terms of equity swaps between companies could increase, marginally over the next, I would say, year or 2 years. However, very large cash M&A exits is something that, we believe in some of the key sectors that we track closely. We don't see that as a big outcome. Yes, there could be smaller, few $100 million worth of smaller acquisitions that companies could do for cash, but large consolidation would largely be with mergers and largely more equity swaps, less of cash deployment.
That's right. Okay, so consolidation could be there with share swap. But one thing I wanted to just put across, that the public markets want what's the bottom line. And that's been the focus of the public markets. And the startup world has come around and has been on track to profitability when they have to make it to the IPO market. So that's one big change that has really taken place. Thank you so much, Rahul, Disha, as well as Karan, for joining us for this interesting conversation. With that, it's a wrap on this edition of Big Deal. Thanks so much for tuning in.